Good evening. Good afternoon. Thanks for joining us, everybody. We are here to talk about liquid funds, crypto venture 2.0, the dynamics between both of these markets. We have a great group of panelists here. I'll be your moderator. My name is Tom Dunleavy. I'm a seed stage focused investor at a fund called MV Capital. If we could start with you, Ryan, maybe just an overview of yourself very briefly, and then the types of strategies you manage.
Yeah, sure. So Ryan Watkins, co-founder of Syncracy. We're a thesis-driven hedge fund that makes contrarian bets on the secular winners of the crypto economy.
Hi, I'm Jack Platts. I run Hypersphere Ventures. We have a liquid hedge fund as well as a series of venture funds, and excited to talk to you guys today.
Hi, my name is Kavita Gupta. We have a pre-seed seed fund and also a liquid token fund.
Hi, Seth from CoinFund. We have two different venture tracks, early stage, Series A, and a liquid fund. I run our liquid fund. Background is 18 years, large cap growth equities investing.
Fantastic. So let's set the stage. We had a very strong start to this year. We've had what feels like 6 months of apathy. In your view and in the view of your fund, where are we in the current cycle? Where do you see the next 6 to 18 months going? And how are you positioning for that environment? Ryan, I'll start with you.
Yeah, sure. So like you said, the start to the year was very strong. We had the approval and launch of the Bitcoin ETF. Later, we had the launch of the Ethereum ETF. And we started to see the early signs of, I think, institutional participation in the asset class. But I think what happened is at a certain point in April-ish, we started to get ahead of ourselves and kind of market got derailed. But I think for us, we're still very excited here. I think the institutionalization of the asset class is not just like a cyclical story, it's a secular story. And the underlying fundamentals of the projects continue to accelerate as well. And that's one thing that we've been really focused on over the past 3 to 6 months as we kind of been in this quiet period is really just gut checking ourselves and making sure, okay, is everything in the crypto economy continuing to compound? And that's certainly the case, whether you look at DePIN or DeFi, stable coins. These are just kind of all up and to the right. So yeah, we remain constructive, especially as we head into year end.
Yeah, I think that's a great summary of the year so far. From our perspective, the upcoming catalyst is obviously the November election. I think overall it'll be a clearing event for crypto. So it's been a politicized issue, whereas the Republican Party has become more officially backing crypto, whereas the Democrats have been less so. Therefore, everyone's kind of view is if Democrats win, it'll be bad for crypto, and if Republicans win, it'll be good for crypto. But I think it's actually more going to be a clearing event where once the election's over, we can look towards kind of the fundamental innovations going on and adoption curve generally that's going to continue regardless. And then deficits under both administrations will ultimately probably be bullish for Bitcoin and crypto generally. So I think that'll be the next catalyst coming up. And for us at Hypersphere, we're continuing to invest in long-term fundamental views in terms of the adoption curve for projects we're excited for 3, 4, 5 years out.
Yeah, I think overall on the summary side, yes, it feels like everybody thinks election is going to be the best catalyst. And I do believe if Republicans win, we will suddenly see the whole boom cycle in one night. Of course, we don't have any clarity from Democrats, but ultimately I do feel like whatever party comes, the Fed rate has to be cut more. The inflation has to be taken care of. And that is going to trigger crypto, whether it happens in small pieces, like we just saw the Fed rate cut in September and we saw the prices going up, especially the alt rallies. Whether that is taken whether different parties wants to claim it for different events. But I do feel like that the Fed rate expected cut and waiting for that liquidity in the market. Said that, I think I'm hopeful about Q1, Q2 of 2025, irrespective of the government. Of course, it can be accelerated in November based on one party over the other. Also, the other thing is we sitting in US underestimate the power of the political affairs in Middle East and Europe. We have seen a very big dip when some of the earlier combats happening in Middle East happen. And currently what's happening, if that continues or that gets escalated, that could be one of the dampening effect, which I'm hoping is not going to be the case.
Yeah, I agree with a lot of what's been said. I'd step back and frame the setup as we see it from a top-down crypto perspective, bottom-up crypto perspective, and macro. The first two really being secular growth. So top-down, the story as we see it is we're on the path toward regulatory normalization. That is defining the regulatory regime, particularly in the US, that's seeing more bipartisan support for crypto. We're on that path from last year, really from mid last year. You had the SEC, the bank regulators, the prudential regulators going after crypto, and that led then the pendulum had swung really far in the tightening direction, and then it started to swing back as you started to have challenges from Coinbase. You started to have court wins, things like the Grayscale case, which paved the way for Bitcoin and then ETH ETFs. And then this May, a step change in that path. So an acceleration where we were already on this 2-year path, but when you had the SAB 121 repeal bill pass the House, and then you had President Biden say, if this passes, I'm going to veto it. And then you had Trump respond, again, pendulum swinging back and forth. Trump responded, if you like crypto, you need to vote for me because President Biden and Elizabeth Warren and Gary Gensler want to take your coins away. That led to this broader debate within the Democratic Party around why are we anti-crypto? You had Mark Cuban, a bunch of big donors coming out saying, this is an innovative technology. We should be supportive of it. We shouldn't let the Republicans own this. And that eventually led to the reversal on the ETH ETF. And most recently, the Harris campaign, as of a week and a half ago, explicitly saying that they support digital assets and then putting it in their economic policy document. From a bottom-up perspective, more vertical seeing engagement, like real developer, real business engagement than we've ever had this early in a cycle, whether it's DePIN, whether it's gaming, whether it's DeFi. So lots of interesting things going on there, secular growth as well. And then from a macro perspective, coming into the heart of a big liquidity cycle, it's not just the Fed cutting by 50 basis points, but it's the fact that the Fed cutting by 50 basis points meant that China could come with a bunch of stimulus and not be worried about the RMB weakening too much, and they've come with a lot of stimulus. So really good developments, top-down crypto, regulatory developments in particular, bottom-up, fundamental, and then macro, cyclical, giving us a very nice tailwind.
Fantastic. So let's take it a level deeper. Let's look at the actual nuances of the market that we're all investing in here. So token supply has been a big topic. So we have 20 billion plus in unlocks by numerous sources coming over the next handful of months. You have 10 billion plus in new protocols actually coming to market. The intention for investment is hugely fragmented. So on the liquid side, how are you thinking about these new projects coming to market? And on the venture side, if you're allocating there, how are you advising projects to come into market in sort of this environment? Ryan, I'll toss it to you.
Yeah, sure. I'll start on the liquid side. So for us, we look at it on a case-by-case basis. And high level, the framing for us is that the problem isn't that the float is low at the time that these projects go public. The problem is the projects are overvalued. And so many of the projects, price discovery takes place in private markets. So you have many cases where, if a project do a seed round and $50 million and then an A at like 100 and so forth. And by the time it goes public, you have $1 billion project that is, 1-2 years old and it doesn't do anything. It's worthless, right? So it has nothing to do with the fact that the supply that's circulating currently is low. It's everything to do with the valuations of the project. Now, the second thing is that it's actually less about the supply of the projects. It's more about the fact that many of these tokens just don't capture value either, right? So I think for us, we're not systematically avoiding any of these. we're taking on a very case-by-case basis, and where the valuations do make sense, we'd be willing to bid. And then I think maybe the last thing I'll say on the topic is that there's also a problem with incentives for founders and core teams as well, where you can build a project that has zero product market fit, go public within 2 years, achieve $1 billion valuation, and be liquid on it when it goes live. I mean, that's just not normal to be able to launch a project and then as a founder be liquid on 8 figures, 9 figures of basically like equity and be able to sell it. I think for many people, even people who are very optimistic about this technology and believe in what they're building, that's just kind of hard incentives. Like I think many people would be inclined to just sell it and then just go walk away. So I don't really have an answer for maybe on the private side, someone be able to provide perspective. I don't really have an answer for how we fix the kind of incentive misalignment at the early stage for some of these core teams and founders. But when you combine the fact that, once again, price discovery happening in private markets, overvalued by the time they come to public markets, and then early liquidity for core teams before they deliver a thing of value, that's the reason why we are in this situation.
Right. And the structure of the venture capital market in crypto is different than traditional markets in that there's a glut or a lot of demand for seed stage, pre-seed stage, and Series A.
Oh.
And then there's not much B, C, because you get liquidity faster and you can launch your token by that point. So there's all this demand at the front end that gives also on the secondary markets. Ryan mentioned you can get liquidity within 2 years. Well, when you launch your token, for some projects, founders are getting liquidity even prior to that point, or they're selling secondaries at a markup from their seed round prior to launching a token or a product. And that just shows you how much demand there is from people who maybe didn't get in the seed round, but will play seed round plus 50% or seed round plus 100% on top of that to give the founder additional liquidity. And that's just kind of how it is. We advise our founders to secure a nice house, but maybe not 2 in a boat, because at that point you could probably get distracted from the core piece. So that's kind of what we say there. But in terms of the liquid side, where we make kind of longer term bets is typically in projects that have reached some sort of escape velocity, and we can work with the founders or the team to buy tokens that are locked up for multiple years. And they're usually through some of the overhangs on vesting, or at least have a path to get through some of that. And we can come in and go, okay, great, they found some product market fit, like we did this with Telegram. We're looking at a couple other deals as well, kind of in this distribution angle. We're very excited about getting more users in crypto. We feel like there's a saturation point where everyone who wants to self-custody Bitcoin or crawl through Glass to use DeFi has basically done it, and there's pretty much slow organic growth there. But so we're looking at ways to bring in tens of millions of more users through DePIN, things like WorldCoin or others, as well as Telegram through the 6th largest social media company in the world.
I think for us, I've always been an early stage investor, and only last year I came to a conclusion that crypto has become a very different game than what it was back in 2017 or even before that. In 2017, even if you're running a pre-seed, seed stage fund in blockchain, your tokens are like 5-day, 1 month, 15-day lockup. So you're literally sitting on most of the tokens 3 months, 6 months into an investment to a project. Now, a lot of those has changed for very good reasons. And but at the same time, the valuation bubble by VC at this pre-seed stage, seed stage, $100 million, $150 million seed stage valuations have a lot of risk associated with it. Like, even if the founders are great, but there is really no test net, there is really no product. We still don't even know what is going to be adoption, go to market. Are they good at building technology? Are they good at building execution plays? How to take a risk on the founder side without anything at $100 million valuation or $150 million valuation without having a single customer. And when you do that, and you then do your seed, then your Series A, by the time you are ready to go to the market, you are a multi-billion-dollar valuation, is the market and the exchanges are really there to support And we started seeing that was not the case. And the bear market, some of the best projects and really good technical projects, which we enjoyed looking at, but the valuation was so high we couldn't. We found them in much lower valuation than their seed round available in the market now with less risk because they are tested and with much more liquidity around it. So I felt like that compelled us last year to start a liquid token fund. And the idea of the liquid token fund continues to be the technical fundamentals, the same diligence as we do if we are investing in them in early stage. But that does pose a very important question for us as an investor, even from a pre-seed stage. What is the right valuation for us to go? And if we are not happy with the valuation, but really excited about the team, how do we keep track on them and come back and circle back right before they are launching the token or at the time of them launching the token?
So I think everyone has kind of talked about how important fundamentals are, and I'll second or third or fourth that. If you have strong fundamentals, you're still getting rewarded for those fundamentals. But there's a really interesting dynamic where low float to FDV is negative if you don't have great fundamentals and or if we're in a market downdraft. But low float to FDV can actually be really positive, accentuate the move up if we're in an updraft and or you have very strong fundamentals. So in the end, it comes down to, and fundamentals, Tom asked backstage, what do we mean by fundamentals? That can be eyeballs, right? Like maybe this is the late 90s and we're using eyeballs to kind of figure out where there's traction. Maybe it's fee generation. I don't think it has to be actual token value accrual today. But show me activity, show me that you're consolidating market share and that you're attracting more users, that you're getting a good ROI on customer acquisition. And I think your token is going to reflect that.
So
Yeah, go for it.
yeah, quick follow-up here. So we talked a lot about the problems with the structural supply issues. I also just want to really quickly touch on the opportunities as well. So historically, there was this game that you could play in early stage venture capital where you can arbitrarily fund any early stage infrastructure and then sell it at 100x in like basically 2-3 years. And that's what people did. So it didn't really matter what you actually funded, say in 2017, 2018, you could just sell it for 100x. So naturally, that just attracted an enormous amount of capital into early stage venture, specifically to invest in infrastructure. And I think what you're starting to see the signs of now is that there's just exhaustion in public markets where people just aren't willing to bid the 100th smart contract platform that's going live. And I think that's a sign that we are starting to see early winners emerging in public markets where you have like Ethereum and Solana, and maybe there's room for like a couple more. So you don't actually need some of this infrastructure that's being funded anymore, and that's why they're not getting bid. And then on the second point here is that if you just look at the top 25 projects by revenue generated, only 6 of them are infrastructure now. It's primarily just Ethereum, Solana, and Tron. 19 of the 25 are applications. So I think there's like a massive imbalance between the amount of funding and attention that infrastructure is attracting versus applications, when applications are actually starting to out-earn many of the infrastructure that exists in this asset class. So once again, I just want to highlight the opportunity is that there are winners emerging at the infrastructure level, and there are applications that are actually generating more revenue than infrastructure, which are valued at 10 to 100x more than those applications.
I quickly want to add something. Sorry, Jack. I feel it's also the incentivized mechanism, right? If you are doing an L1, L2, and even though ultimately you're building an application, but it's so cool to say you have an L1, you have an L2, you have an L3, suddenly your valuations goes in three digits $1 million, right? If you're saying, hey, I'm going to go and build a cross-chain DeFi application, and then your valuation is sitting at 30, 40, and this is like how VCs somehow, I don't know what is the parameters for it. For us also, we don't know what the parameter of it, but somehow it become an unsaid standard. Oh, you're building an app, you're doing a seed round, it anyways between 20 to 40, let's see what you can pull. But as soon as you say, oh, but by the way, there is a chain associated with it, now we are building our own chain, you are suddenly doing your seed round at $150 million because there's a whole token game to play, which every VC, and I'm generalizing, but definitely like the way we think, wants to then say, okay, then is it going to be the next Solana? Is it going to be the next game I can play? And ultimately, all the ETH killers or all the blockchain killers, when they come, they try to find their go-to-market and the community issues. But if you look at their FTVs in the market, as you talked about, the revenue versus FTV, if the Web2 investors start looking at it, they would be like, what the hell scam is going on here?
Yeah. That's a great summary because we talked about valuations, we talked about attention. Now, those investments that you might have made in the earlier stage may have either borne fruit in the private markets, as you guys hit on, or not. But there's this huge opportunity, a growing market now in secondaries. So you get another chance, potentially, either buying from the foundation or buying from another VC to invest in a lot of these tokens. So, how are you seeing the secondaries market today, personally, as an investor? But for projects, are you advising them to consider these opportunities as well? And we'll start from the other end this time so Seth doesn't get all the scraps.
There's an element of secondaries, particularly when we're buying from the team that I really like, and that's that we're giving capital to the team to continue to develop the project. So that capital should be should have a multiplier effect on allowing them to expand their runway, expand their team, and the core contributor base. We were talking about this a bit earlier, though. I think it's fair to say that the discounts, even though they're in the 30 to 60% range, don't accurately reflect the volatility of the space. The hit rate when we do treasury deals, the hit rate 6 or 12 months out is actually quite low, meaning you're buying from teams that either know that they've kind of exhausted their catalysts or for whatever reason feel like they're kind of at a flow in the activity of their blockchain. And the hit rate of actually having them be up 6 or 12 months out is relatively low. The ones that do work very well, but they're few and far between. Now, when you get to a 3-4 year time horizon, I think that the hit rate moves up again.
Yeah. I think the discounted deals are also very interesting. Like before everybody starts seeing the perp markets openly to let market decide what is the valuation, people are ready in a much more retail space. Still a very degen space, but retail space. Before that, all those secondary deals with like 50% discounts, 60% discounts on your Telegram bots would really tell you which project at which place people are ready to put their valuation prices are from the retail side or the secondary sale. But what is very fascinating is the lockups. I think, and I don't have an answer for it, but I feel like from 10-day lockup to 1 year lockup and then 3 years of vesting thing for a very early stage investor who probably have invested 3 years before you ever did your TGE. So that 7-8 year of cycle of having liquidity to really realize your return does not work in 90 to 95% of the projects. That would be one project. If you have gone into it as a fund, will take care of the rest of it, which may be what the hedge fund model is. But as a VC, it just started becoming a very interesting phase where, okay, I'm going to get into it early, and maybe a lot of VCs have started talking about their exit plan is not just a 40% discounted to their token prices of the market and get out of it. And I think if you getting into a project and supporting a team with that thought process, and maybe you have to do it because of your LPs, that's not a sustainable way. But the other way which I see around is having more liquidity around these secondary deals with some unlocks. If the market is very liquid, suddenly you have a bull cycle, like based on the seasonality, to have some flexibility on those lockups by the founders too.
Yeah. So how we think about the treasury deals or secondary or longer term investments in projects that are further along is we want to back differentiated products led by a visionary founder. So I mentioned WorldCoin. There's not many Sam Altmans out there. He's behind WorldCoin and helped found it. It's also operating at this intersection of crypto and AI and has a great distribution story around the orb. So that's something we've been looking at for secondary and are excited about. Another one is Pavel Durov standing up for free speech for Telegram, and he has his own token. It's the 6th largest social media network in the world. The first 5 can't legally launch tokens. And so we were excited about Ton and the distribution story there as a new platform for bringing on more users into crypto, and also the ideas behind free speech. So that was an interesting one. And if Elon Musk ever launched, it's like those types of founders doing really revolutionary things where you can bet on over multi-cycle views, and these guys aren't going away. They're going to continue to build something very exciting. So we tend to back big ideas with a lot of capital for the long term. And when we look at secondaries, but you do have to Seth's point, you have to be very careful about timing for some of these things because, it's a very volatile market.
Yeah, so for us, our DNA is very much public markets. We don't need to do any private transactions, so we do it very opportunistically. Where it makes sense is we run a very concentrated strategy, and naturally we have relationships with all the core teams and founders in our portfolio. It's not that hard when there's only so few in the portfolio. And when there's an opportunity to just add more to a position that we have already done diligence on and are excited about, potentially at a discount and where the liquidity on that transaction makes sense, then that's what we would do. And we've done a couple historically that kind of fit that criteria. But yeah, that's how I think about it is. And maybe one last thing, because I know we kind of talked about like the discounts that you could potentially get in secondaries. For us, the discount is not really a factor at all. It's really just, are we excited about purchasing at this valuation that we're being offered? Because I think as Seth might have mentioned, there's countless examples of, deals where you've gotten like 50, 60% off. I think infamously in like the 2021 to 22 period, there were a ton of treasury deals done at the 2021 peak. And you thought you were getting a big discount buying one of these assets, 60%, 70% off the current price, and everything collapsed 95% in the bear market, right? So you just have to be excited about the purchase price, not about the discount.
Fantastic. So 3 minutes left here. Let's do a quick lightning round, 45 seconds each. Biggest non-consensus take on a sector, a vertical, conventional idea that is proliferated the space, and I will toss it out to whoever has the hottest take or is ready to go first.
I mean, it's interesting. We've been talking about altcoins quite a bit. We're an altcoin fund. We're very bullish on altcoins. I actually think, though, historically, and I don't know how out of consensus this is, but historically when Bitcoin goes through its 3-year all-time high, you have a move where Bitcoin is outperforming most other coins. It doubles very quickly. So I think as we approach kind of 75,000 as the decisive breakout level, base case is that we see a very big move in Bitcoin and a move that is a high dominance move.
I feel like I'm going back to when I'm looking at the tokens going on the sector. Meme coin has saved some liquidity over the bear cycle. And there was a narrative of T-pin, which I don't see as of now picking up when it comes to exchanges from VC side to exchanges really converting. Same thing we saw a big dump into restaking. But some of the narratives which I'm very excited about is I want to see if the use case bases L1 and L2s are really going to come out and going to have adoption. Because if people wants to just build really fast trading strategies or wants to bring, let's say, a shopping app or something, then I think security versus latency versus cost, like different specialized L1, L2s, tokens and the sectors. I'm excited to see how does that play out, because I think that's going to change the complete narrative of how in the next cycle we're going to see the applications coming.
For me, I'd say distribution is more important than technology. There's a lot of excitement around how fast, how many TPS and so forth. But for us, we're investing based on bringing in the next 10, 100 million, billion users. And so we're focusing on investing in things that can distribute to a rather large audience like Telegram, like DPIN, and others like that.
Yeah, so I'll try to be brief here. while Solana has been the center of attention this cycle and likely will continue to be the primary venue for retail trading and likely lead all ecosystems as far as just activity, the growth of activity on chain, I actually think the pendulum has swung too far in the direction of integrated systems versus modular. And real quick, I think if you look at what happened to Solana in earlier this year, it started to buckle with just a couple million people just gambling on meme coins, right? And that was basically Solana doing about 600 transactions per second in non-voting transactions. You're already starting to see early signs of Solana start to modularize itself. I also believe that modular systems will be able to compete performance-wise with integrated systems over the next 6 to 12 months. And I'm really interested to see that pendulum kind of swing a little bit back towards the modular direction as people kind of lose faith in the Ethereums, Eigens, Celestias of the world.
Fantastic. Well, I thank our great panelists here. Thank you for listening, and appreciate the time, everybody.
Thanks.
Thank you.